Hey everybody, Hutch here, and if you made it this far, you realize that this is not a bunch of smoke and mirrors, not a big scam, or at least you suspect that something good might be going on, and you want to know how it works, and furthermore, what could go wrong? What's your risk? What's your exposure in this deal? So let's first talk about who this is for and who it's not for. Who it's not for. It's not for people looking to get off the grid. The insurance company is not going to accept your premium in small unmarked bills or give you loans in Bitcoin or whatever. It's not for people who are playing massive catch up and they feel so behind they're looking for some magic bullet that's going to 20x them out of the hole they've dug themselves. Not going to happen. Now, if you're already making 20x, great. Go ahead and funnel it through this first and it'll even optimize that further. But if you're expecting this to bail you out, not going to happen. For those of you that are drowning in debt, even though there's certain books that say this magical policy can just like wipe away all your debt and everything's going to be awesome, if you have irresponsible savings and budgeting habits, you're probably just going to make a mess of this too. So you should clean that up first. And kind of our rule of thumb, even though there are other groups that advocate that you kind of wash away your debt through this, if you're within a year of wiping out that debt, maybe you could start something. If you have multiple years worth of bad debt, you should probably knock that out first and get a convertible term policy. And when you see the light at the end of the tunnel, fine, go ahead and start something. But otherwise, you really need every penny to knock out that cancerous debt. I know that could get me more business and it sounds really gimmicky, but we're just not going to go there. So who is it for? Who does best with this thing are entrepreneurs and real estate investors who have some debt or are used to using other people's money and managing arbitrage and getting a spread off that and getting a better return elsewhere. They kill it with this strategy. Once they understand it, they realize they don't have to be in a hurry with the projects or the endeavors that they take on, because at least when they're going sideways, the money's growing for them, it's liquid, it's powder's ready to go, and they're at least earning a competitive interest rate along the way, not to mention all the other benefits, offensive and defensive. Also, fiscally responsible families, savers. We have a lot of these people that actually hate debt. They are so conservative that like really takes a lot to rewire their brain to say like, hey, this is okay. And one of the things I tell them is, listen, if you're able to borrow at a very favorable rate and very favorable terms, and you can earn more on the credit side, and the amount you have over here in the asset is enough to wipe out the debt at any given time, are you technically in debt? And that helps to make them feel a little bit better about it. Like, you're not really in debt if you have a corresponding asset that's more than what the borrowed amount is, that you can just wipe it out at any time. That way, if the spread becomes unfavorable, if for whatever reason the game isn't as good as it used to be or just gets really upside down and sideways, they can just knock it out and be on their way. But for the last like as far as I can remember, and even agents that came before me, there's always been a spread. And this is because, well, we could just look to the banks themselves. Where are they putting their safe money? They're putting their tier one capital, their safe and liquid reserves, as much as they can into insurance policies on their employees so they don't get in trouble like Walmart. They can't do it on the rank and file, but they're doing it on their key executives. There's a reason for that. Right? Banks are terrible savings institutions. Like, they give you a really crappy savings rate, but they're wonderful lending institutions. Conversely, life insurance gives you a great growth rate, not to mention the nice tax arbitrage that a bank can't give you. Like, there's no bank that says, hey, we do so much for widows and orphans that the government kind of blesses. As long as you keep a certain amount of money in our bank, you can kind of put money in, take it out, borrow against it, do whatever you want, and no tax on the growth because we're doing so much for widows and orphans. Bank can't do that. Hedge funds can't do that. But life insurance companies can. So because of those two things, you get a better crediting rate with the life insurance. But when it comes to lending, you can borrow against the policy at the life insurance company, and certain ones are better than others. But even the best ones aren't as good as the programs we can directly plug you into with banks. Now, why is that? Again, banks realize that, first of all, this is a paper. They're allowed to take in $1 and loan it out 5, 10, 20 times, whatever it is. So this is kind of like free money for them. It's not the most profitable loan, but why wouldn't they just take it? It's just like, thank you. And that ought to tell you something in terms of risk. We've been over that before if you watched the last video. So let's talk about the policy itself. So traditionally, infinite banking is dealing strictly with whole life, and we love whole life. I own a lot of it. Been loving it, especially right now when I'm filming this video. Markets are going down. Love my whole life. There's other times markets are rip roaring that way. Love my IUL. I have both, right? So we won't get into the details. And by the way, there's going to be resources on this page. And if you're on YouTube, we'll have links to resources below where we have all kinds of supplemental learning pages where you can learn more detail about how these works. We're not going to get into that because they both can work if the policy is structured properly. So beating banks at the savings game is easy. The liquidity game is also huge. Now, obviously, at a bank, you can take out 100% of your account at any time. But when I ask people like, okay, what's your emergency fund? Some people it's 50,000, some people it's 100,000, some people it's 250, some people it's 500. I call this the financial teddy bear. Everybody has an amount that they just kind of feel comfy just sitting there. And so let's just use 100,000. So with life insurance, if you can borrow 95% of your cash value, if you have 100,000 of cash value, and some people are like, I want 100. And again, it's that financial teddy bear. But I ask them, okay, you have 100,000 in the bank. When's the last time you tapped that thing down to 5? I can't remember, maybe never. How about down to 50? Once, maybe. How about down to 80? Right? Where you're tapping 80 to the 100 grand. So why are we worried about this with the 95%? We shouldn't, because that extra 5% you're keeping in there as equity, the whole thing's compounding for you, but the 5% that you can't touch is propping up your place in line in this privileged tax-exempt account, not to mention all the protection benefits. If you kept 100,000 in the savings account, what else would you probably be buying to protect your family? Probably be writing some checks for some term insurance, right? Well, there's your 5% right there, whatever it is, right? It's going to vary for everybody, but it's right there. So what could go wrong on the credit side, on the policy side? Like the place that everybody goes to right away is like, what if the insurance company goes bankrupt? In the resources, I have bankytruths.com/safe. It's a whole article about that. A lot of people don't realize that during the Great Depression, before there was FDIC insurance, which is a total myth, by the way, we'll talk about that when we get to the banks. When banks were actually failing, guess who bailed them out? It's on record. Insurance companies, because since they can't lend out $5, $10, $20 for every dollar that they have there, they actually have to keep about $1 and a nickel to $1 and a dime in reserves because they're held to higher standards. They had all the liquidity and they actually bailed out some of the major banks during the Depression. It's an amazing story, actually. And I take a lot of pride in that. Nowadays, there's FDIC. Everybody feels really good about that. But banks are still allowed to have these loosey-goosey fractional reserve standards, and life insurance companies still have these old, stodgy, very conservative standards, which is very important. So what else could go wrong? Well, on the insurance company side, if there's a disconnect, and this is probably the biggest risk, right? Let's talk about the elephant in the room. If there is all of a sudden a disconnect between how much the policy is earning and how much you're borrowing against, obviously you're going to be upside down for a little bit. Now, what I can say is I've had a lot of clients that have been worried about this for a long time, and they're 5, 10, 15 years to the good on this. So if it happens temporarily, because it could happen temporarily, it's a temporary thing. And what did we already talk about? If you can extract 95% of your liquidity and invest it in a passbook savings account at a higher rate, or invest it in a non-callable investment grade bond at a higher rate, then you're not really at risk that much if all of a sudden there's this disconnect temporarily. And I have an entire video in the resources called What Could Go Wrong? And I actually share a story about how a mutual company did that when rates spiked last time, is they just kind of went all in on these non-callable investment grade bonds. And they made a massive profit to the point where they needed a private letter ruling from the IRS to distribute the dividend, because it was going to be a massive dividend, break it up over 5 years. But I digress. So there's things you can do, like if you're worried about inflation or whatever, like, you can take out 95% and invest in gold or silver or crypto or whatever and keep that 5%, which also props up protection, but it also kind of maintains your place in line just in case it is temporary and things come back to earth. Like that's really the worst thing that can go wrong. So if you can get comfortable with that and understand that you actually retain control and liquidity of this 95%, most of my clients can get comfortable with it. If you can't, I get it. You got to stick with your financial teddy bear and opportunity cost that comes with that. Let's talk about what could go wrong on the micro side, meaning like what could go wrong with your economy. A lot of times people, change jobs. They start a plan and now they have to downsize it. So this is often a big concern of people, and we spend a lot of time when we run illustrations. We run one called Armageddon, where it's just like, oh my gosh, you do everything possible without shutting it down. Just like lower the death benefit, lower the premium payments, paying the minimal, doing a reduced paid up, which is, by the way, a contractual option within whole life. With IUL, we just reduce the death benefit after the 7 years so we don't violate MEC. Lots of things we can do if just things are like, oh my gosh. But again, most of the time, there's usually just a temporary disconnect with people's personal economy. There's a lot of flexibility. Whether you do, with IUL, there's ultimate flexibility. We illustrate for people that if you make one max payment the first year, when usually people are getting into this, usually they are making that max payment the first year. Like that's why they're getting into it, because things are going well, or they have excess liquidity that they want to deploy more efficiently. If you max fund for the first year, you could skip the next 4 years and be fine. Like just pay zero in IUL. Can't do that in whole life, but a lot of people don't realize this, depending on how you structure the policy. But if you do the traditional kind of minimum base, maximum term, overfunded with PUAs, the number's somewhere between 20 to 30%. And what I mean by that is whatever your maximum premium is, which is usually what we're focusing on to how much we can fit in, because we're limited. The IRS only let us put so much given how old you are and what your rating is, how much death benefit you're going to buy, and everybody wants to shrink wrap the death benefit. When you do that, let's just say your premium's $50,000. Well, your minimum premium is only going to be on the very high end, 30% of that. So about 15. And most people are usually comfortable with the fact that, I can at least do that. Here's the other thing. What can you do? You can borrow against your old cash value, your old premium payment to pay the minimum or even the maximum. And when we illustrate that for people, that's actually usually the best way is to, even if you borrow against everything, to pay the maximum amount, that you get more money in there sooner, compounding for you. Like that's usually a good thing. Now, obviously, if they've already tapped all their equity for something else, they wouldn't be able to do that, in which case you could just float the minimum monthly payments. But as we said before, when I talk about people's financial teddy bear, they're usually not overextending themselves to that degree. I do have some clients, very aggressive real estate investors and entrepreneurs, they do, in which case you just have to float the minimum monthly payments. On the low end, it could be as little as 20%. Kind of depends on your age, health. So in that $50,000 example, maybe as low as 10, maybe as much as 15, it's going to be somewhere in that neighborhood for that minimum monthly. So let's talk about the loan, right? So we talked about on the credit side. Let's talk about on the debit side. So you do have a policy loan, and a lot of times maybe they read books or it just sounds better. Like, I don't want banks. You don't have to get a bank. But if you can borrow from the insurance carrier at 4, or you can borrow using an outside line of credit at 3, which would you rather do? Like 1% compounded over multiple decades? That's an extra 1% of growth compounded over multiple decades? Adds up to be a lot. And a lot of people think, 1%, it's not that much. It's not one. And I have a different video with a course that we call hybrid, where I have a whole compounding calculator and we show this. That 1% difference, right? It's actually earning 4% versus 3%. That extra compounding you get, 4 versus 3, makes a massive difference. And every number you go higher, like it's actually closer to 5 right now. I'm just lowballing everything. But if you're in 5 versus 4, that's a lot more. If you're in 4 versus 3, that's a lot more, because you're getting compounding on the 4 or the 5, not 1. So we talk about that. So a bank loan is definitely a way to go. And people say like, oh my gosh, they can run credit, blah, blah. Yeah, if you have bad credit, you can't get it. But if you do have good credit, depending on the bank that you use, and we have some that just do basically a hard pull of your credit to make sure you're good, but then they don't report the cash secured loan on your credit report, which is nice because according to their banking standards, since it's backed by the policy, you actually sign what's called a collateral assignment form, which they don't it's still your policy. It just says if you stiff them, they can actually put the loan back to the policy and let you deal with it, which is pretty much the only recourse that they would take. So if you're trying to get away from the bank, yes, you can use policy loans, and then certain policies are going to have more favorable loan rates than others, and we would optimize towards those. People say, what happens if the bank goes broke? Well, and this is where it kind of gets back to FUD. FUD stands for fear, uncertainty, and doubt, and people just get all kinds of FUD. It's funny, like I spend probably 98% of time with my clients talking about the 1% of thing that could go wrong versus talking about what could go right. And this is a perfect example. Like, well, what happens if the bank goes broke? Well, let's think about that. They already gave you a loan. You're the one that owes them money. If they went totally broke, that'd be good for you. I don't see a universe where somebody's not going to like buy them out and try and collect that debt from you. But I mean, there's nothing to be afraid of. You're in the driver's seat because you're the one that got the darn loan. So as far as what if there's a disconnect, we've already talked about that. Or what happens if you can't make the loan payments? Well, it's real simple. You can borrow a little bit extra. And when we're talking 3%ish, you borrow a little bit extra to just make the loan payment, have at it. Certain banks as well will let you just accrue interest. So you just pay back when you want to pay back, and the loan just kind of accrues against you at that 3%, and you just pay back when you pay back. It's just kind of like a floating sliding scale. As long as you pay the 3% regularly, it actually works out to be simple interest, right? Because you're just constantly paying the interest. You flatten the loan balance. If you let it accrue, it can get compound. But I've actually done this to where I just pay when I can, and I usually pay bigger amounts, and it's just kind of like a floating line of credit. And this is the other benefit to it. It's actually online. So there's certain ones where they just give you a checkbook, and you got to write the check and hope it clears on time. I mean, it's unbelievable to me how backwards banks are and how slow they are. We're still on like 1850s banking standards. But there's one bank that I like to deal with where they are online. I just link however many accounts I want to. It's ACH, free ACH within a day. And I put the number in and boom, it's there within a day. If I need to go over that, I can request a free wire, I can do a form, or I can actually call them up and just go over all the data. They send it to me on DocuSign. It took me a little over 20 minutes, and as boom, I DocuSigned that day, the free wire went out. So that to me is a lot better option. As far as what could go wrong, again, you're in the driver's seat, so there's not a ton that you really need to worry about there. Okay, so hopefully we handled everything that could go wrong. Now let's talk about what could go right. And it's so interesting to me. I learned this in behavioral finance. It's called loss aversion. It studies with college students. They found that people in general tend to worry way more and devote way more energy to protecting, say, $100 than to earning the same $100. Like, we're so worried, and that's why we spend 98% of our time worrying about 1% situations. Here's what could go right. Since you get a better growth rate and you're parking your liquidity there, you end up with a lot more liquidity down the road. So if you are a real estate investor and you parked your money in bank accounts in between projects, there's an opportunity cost to that. Versus if you parked it in life insurance and borrowed against it, most likely you're going to have a lot more liquidity for future investments down the road. Also, you are going to have dollars doing double duty. So again, you're borrowing to use for real estate, but your full account balance is in there growing inside the policy. It's not like a 401k loan where you borrow from the 401k and you actually rip the investments out and you kind of pay back and slowly dollar cost average back into those investments. No, your full balance is compounding for you in addition to whatever you borrowed the money to do. It's also talk about extra net spendable retirement income. So everybody at some point is going to retire or wants to wind down, even if you're a serial entrepreneur or real estate investor. Last time I checked, more is still more. So people like ending up with extra cash in retirement, but not just any cash. You could rack up a big 401k balance. Guess what? You got a mortgage against that 401k. There's an embedded tax liability. You look at that statement and you think it's all yours. It's not. You got a silent partner in that deal. Whatever you rack up in your policy, that is tax exempt as long as you don't cancel the policy. Even if you bleed it way down and leave just a small burial policy behind, once you do that, everything is consummated as tax free. So ending up with an extra 6 or 7 figures come retirement, I mean, that actually might translate to working an extra few years, not working an extra few years, working a few years less than you otherwise would. Like, think about that. You contribute 19, 20,000 into your 401k every year, and you're trying to rack that up and grow that so it turns into 6 or 7 figures. If you end up with just an extra 6 or 7 figures, like just simply by moving money from one pocket to another pocket, that's a big deal, right? You're working so hard to grind out the savings. What if you just had your dollars doing double duty to end up with this extra pool of tax sheltered, not to mention safe from market risk in retirement, which we'll talk about. There's actually a video about how life insurance helps later in retirement. It's actually a big deal because usually people get to retirement and everything's kind of sloshing around in the market. That's fine when you're accumulating and you got time. People always say that when the market goes down a lot, I got time for it to recover. Well, what about when not only when you don't have time for it to recover, but you're actually pulling from it and cashing out shares? Well, in a down market, that could be a recipe for disaster. So having an extra pool of funds that is immune from market risk is a big deal. Now, this is kind of a weird one because we're talking about what happens if things go right, or what happens if you do life insurance. What happens if you do move money from one pocket to another pocket, build up cash value in life insurance, borrow against it, and something happens to you? So something goes wrong. It's crazy because people worry about what could happen to the policy, what could happen if these 170-year-old companies go broke. We're talking about less than 1% things going wrong. What they don't, people really undervalue is the risk of being on the freeway. You get on the freeway every day or however often you get in there, you have a much greater chance of getting wrecked and dying early on the freeway than you do for a 170-year-old mutual company going broke. But people just totally discount and discredit that. Well, what happens if you kept money in a savings account, your financial teddy bear? Let's say you had $250 in there. Guess what? When you die, guess what your family gets? $250. What happens if over time you funneled that $250, 40 at a time, 50 at a time, 30 at a time, whatever makes you comfortable, into a life insurance policy and borrowed against that? Well, now all of a sudden, if you die, your $250 is going to equal $750, $1 million, 1.5. It depends on your age and your health rating, but you get my point. Guess what's an even bigger risk? Being too sick or hurt to go back to work on a permanent basis. So there is something called long-term care, which is very expensive. Life insurance should not be a substitute for long-term care, but several companies offer a benefit. It's actually a free rider to put on the policy. There is a little bit of a cost to tap into it, where they let you tap into your death benefit over and above your cash value, even though you're not dead, when they deem you permanently unable to go back to work. It actually has to do with your ADLs, activities of daily living. But basically, if you're really messed up, right, and you still have this policy, so you don't get a death benefit, you don't get the mortgage paid off with the death benefit or whatever, but you can't work, having access to that is kind of a big deal. So not a what could happen if things go right, but another what could happen if things go wrong. Having this policy actually makes that better. And that's probably the most likely risk of everything we've possibly talked about. Now, here's the good part about death benefit. Let's say you get to retirement with death benefit. Now, most of my clients say, I don't even care about the death benefit. I don't care about it. It's just about the cash. Let me ask you this. If you got to retirement and you had cash value and you had 401k money and you had some real estate, you have to make that retirement last for your forever and usually somebody else's, usually 2 forevers. People say well, I don't need retirement, or I don't need life insurance in retirement. I just cancel it. I'll self-insure. Self-insure, like if you look at insurance companies, what do all insurance companies have? They have reserves that sit dead there. They're actually mandated to keep reserves. So if you're self-insuring, that entails that you're keeping reserves that you're not going to use as other things. So mainly in a retirement context, a lot of my clients say, well, I just live off the interest and, the principal, I don't touch the principal because I don't want it to bleed to zero and I'll leave the principal behind. Guess what? You're self-insuring, but you've locked yourself out of the principal. But if you have a guaranteed accounts receivable, like let's just say, forget life insurance for a second, because everybody hates that word and they have a hard time wrapping their head around it. But if I said, you had this really rich uncle, and he said he was going to leave you $1 million, $2 million, whatever's meaningful for you. After you died, he was going to leave your family $1 million or $2 million. This rich uncle, it's in the trust. Like as soon as you die, wouldn't you spend your assets a little differently, a little more aggressively, knowing that there was this guaranteed accounts receivable just waiting out there? Right? You wouldn't have to self-insure. You wouldn't have to lock up that principal. You can go ahead and tip into that. You can go ahead and enjoy that. Guess what? That's what a permanent death benefit does for you. It's a little counterintuitive, right? And I realize everybody's just regurgitating and parroting everything they've heard. I don't need life insurance in retirement. Let investments be investments and insurance be insurance. Well, guess what? There is a value to having some death benefit over and above the cash value in retirement. So in the next video, we're going to talk about different types of policies, different ways to structure a policy, different ways to fund a policy. If you start to see the value of what is possible here, obviously the ultimate step is customization. You should use the schedule button to book a call with somebody on our team. Sometimes I personally get involved. Regardless, that's the best way to learn. But we'll at least be able to talk through some different structural ways to do things and maybe even go over a couple examples. See you there.